Capitaland China Trust presentation at their Corporate Day 2023 in Bangkok, dated 24th November 2023. Right, so this is the spread of their portfolio. Not much to say. 12 cities, 11 retail malls, 5 business parks, 4 logistic parks. Right, this just to tell you when they changed their mandate from being a pure retail REIT to including business park and logistic parks. Alright, so nothing much here. This is just the timeline of how they transition. Right, they sold some retail malls and acquired other retail malls and business parks and logistic properties. Right, so you look at net property income and distributable income. This one we covered in the last presentation, backdated sometime in August already. So nothing has changed, right? So the DPU somewhere here is I think 3.8. So for half a year. So if we analyze it, it's something like 7.6 cents, right? So I think 7.6 cents probably somewhere here. So if I were to estimate 7.6 cents, it will be a slight dip from last year's DPU. Right, this one, the comparative yield as of 31st October, they're trying to say it is better than a lot of other yields, right? But at 9.4%, I would say that it's interesting, but to me, it appears like, given the debt, I think went up slightly, maybe a compensation for their risk lah, okay? Right, so 9 month, third quarter 2023 key updates, right? The portfolio occupancy is 93.1%. Shopper traffic and tenant sales both increased by over 30%, but later I'll say why this is, I don't think that great, right? Stable cost of debt rate only increased by 3.55%, which is not too bad, right? Fixed interest rate at 75%, that is good. All right, sustainability loans 30%, right? So revenue went down a little bit. Alright, net property income up a bit and net property income down 8.4%, right? This drastic drop here is actually mostly due to depreciation of renminbi to SGD, right? So this is an inherent problem we discussed last presentation. Right, so GDP in China grew 5%, which is pretty good actually, right? Consumption recovery underway. It's a bit underwhelming because I think with the release of the COVID restrictions, everybody thought that 2023 would be the year China recovers, but apparently not. So this is why their performance has not been great, right? So yeah, I don't think there's too many things here that is very interesting to say. Capital highlights, management highlights. I think the only interesting thing here is they start to sell bonds in China, right? And I think, yeah, I think this is a good thing because I think Singapore's interest rate is high and China's interest rate is lower relatively, and therefore it makes sense to have more loans in renminbi lah, because the interest rate will be less, right? So I actually discussed in the last presentation that I wasn't so happy that they refinance in SGD, right? I would rather them refinance in renminbi, which has a low interest rate and it mitigates some of the currency risk as well. Right, healthy financial position, that's what every REIT says, but I'm not sure that's true because gearing went up here to 42.4% just in 3 months, which is not very good. Right, so average cost of debt is slightly increased only, so this part is decent, but we need to see what goes on moving forward lah. So yeah, so this is the part where I think this is okay. The fixed rate debt is 75%, but the SG denominated debt is 77%. Yeah, I'm hoping that they can really refinance this in renminbi because that would be much better for them lah. It will reduce their interest coverage percentage, right? So let me rephrase. It will reduce the amount they pay in interest just because the renminbi's interest rate is lower than SGD's right now. So adjusted interest coverage ratio is something like 3, right? Which I think is okay-ish, not great. Right, so this is their debt. I think some of which have been already postponed to 2026 and others to 2029 if I'm not mistaken, right? So no refinancing required until 2025, which is a good thing. right? So strong operating matrix. I don't know what to make of this, right? It's just a spread of their portfolio, right? Retail is about 70%, business park 25%, logistics is still small at 5%. Right, so performance, when I look at all these large percentage gains, I'm not very impressed because I'm assuming this off the low base in 2022. So if you look at the rental revisions, it gives a more clear picture of what's going on, that recovery is very slow, right? So it remains to be seen that the China retail environment has improved. However, it can also be said in another way that since recovery has yet to come in, right, then we expect the rental revisions may be more robust moving forward, right? So that's one way to look at it. Right, so shopper traffic and sales going up, that's great. Like I said again, this is due to low base, in my opinion. Right, so computer AIs and better shopper traffic, again, nothing much to say because it's from the low base in COVID. Right, business park, again, very small improvement in performance, right? And finally, we'll just look at business outlook, right? So retail sales growth, all right, fastest rate of improvement since May. So hopefully this carries on to 2024, whereby the actual recovery happens. That's what we hope, right? Policy makers are boosting stimulus, right? So the China government is actually trying to boost things in China, right? And I think it takes time for the money to move into the system. So at this point, the market has, I believe, not responded very well to the China government's stimulus yet, right? Hopefully in the next 6 months or so, the money starts to translate to more spending on the ground, and that in turn leads to an improvement in results for Capitaland China Trust. Right, so since the retail is the main part, I won't talk so much about business park and logistics. Right, so with that, I'll end the presentation. Thank you for listening.